I came across this article titled Dividends Aren't Magic here on Seeking Alpha, and it was written by Beyond Savings. I thought the article was pretty good, and I wanted to share it with all of you. This is part of a new series that I have on my channel. Every single Thursday, I'm uploading a video where I review an article like this here on Seeking Alpha. Now, if you're a follower of my channel, I talk a lot about retiring off of my dividend portfolio because I didn't want to sell my shares in early retirement or in retirement in general. I was never good at picking when to sell, when to buy, and when to sell a stock. And I stumbled across dividend investing, and it really appealed to me because it wasn't about the share price. It was about the income that the asset, the stock or ETF that the asset was producing. And I was able to wrap my head around that quite a bit more than, trying to think about, I have to buy the stock or the ETF at the right time, and I have to sell it at the right time. So this article overall, there were some things that I liked, some things that I didn't quite like as much, but I wanted to give you a brief overview of some of the things that I liked, some of my criticisms. Then we're going to take a look at the article. We're going to take a look at a few comments, and then I'm going to summarize my final thoughts. This article is, it's comparing a retirement, a hypothetical example, if you were to retire off of a dividend portfolio or a dividend investment versus the 4% rule, and some of the risks and things to consider when you're considering both approaches. The main focus on this article is on the sequence of return risks with the 4% rule versus dividend investing. And the example that he gives here in this article is mostly centered around that. Some of the things that I really appreciated about this article is how he talks about how dividends matter, especially in a down market, and really diving into the math behind the example that he shares in this article. The main criticism that I have with this article is the example chosen is a very cherry-picked example. You can go and watch a video and somebody can point to a chart and say, hey, look at the chart. Because of that, you should do X, Y, and Z. And there's a little bit of that in this article. And so that is the criticism that I have. I mean, you can skew any argument for or against an investment depending on how you slice and dice the data. Okay, so I do want to say that I'm a little bit critical when it comes to that. I've read many articles, watched many videos. I know how people can skew the data, and so I want to call it out, and I want to call it what it is. So that is a little bit of a criticism that I have for this article. But with that aside, there's a lot of great information in this article. All right, so let's take a look at it. So the summary here of the article: dividends are payments made by companies or funds to shareholders, not magic money. Dividends can perform a magic trick that can save your portfolio. Understanding the source of cash for dividends can help investors assess the sustainability of a dividend and make informed investment decisions. This is so important. I forgot to mention this a little bit earlier ago, but he does go into how dividends are paid and how companies pay them. If you're new to investing and you just hear about dividends and you don't understand how dividends are, how companies pay a dividend and where they're funding the dividend, it's really important that you pay attention and you listen to what he's saying here. So he starts out the article here that it was co-authored by Rita Morwa. I've been following Rita for quite a while. Rita is more of a high dividend investor. I'm more of a dividend growth investor. And so there's a little bit of overlap between our approaches, but still a little bit different. A lot of the stuff that Rita talks about, I don't necessarily invest in because I'm more focused on the dividend growth side as well. So he starts off the article here by saying, when I was young, I became obsessed with magic. While many might enjoy watching the theatrics of a magic show, my mind was always on how everything was done. I would record David Copperfield and watch, rewind, until the video was worn out. I was always trying to figure out the secret of the magic trick. I go to the library and read books about magic tricks and take what I learned there to deduce how various performers tricked the mind. It turns out that many magic tricks have their basis in math. Those who create magic tricks use their knowledge of math, science, and psychology to devise illusions that create an entertaining show. Today I'm going to perform a magic trick which has its basis in math. Well, the trick probably isn't going to get me. It does provide great insight into how we should think about our investment portfolios and how we withdraw cash from them. So starting off here, dividends don't matter, ? Some have developed the theory that dividends don't matter and that an investor could achieve the same effect by selling off shares as they need cash. Their reasoning is that cash paid in dividends are paid from the company, and therefore the value of the company is reduced by the exact amount of the dividend. This kind of ties into the dividend irrelevance theory that you see here on YouTube. Indeed, cash paid from the company is not available for other uses. The book value of a company is reduced by the exact amount of the dividend with each payment. So what is the one detail that this theory is missing out on? The reality is that the stock market does not value companies based on book value. That's a good thing for them, for the Magnificent Seven, as they trade at enormous premiums to book value. And here on the screen here, you can see the book value of the Magnificent Seven companies here. You can see how they're trading at massive premiums. Alphabet trades at the smallest premium of just 785%. It would only have to fall 83% to trade at book value. Nvidia trades at the largest premium to book value and would have to fall over 98% to reach book value. I'll go out on a limb and suggest that these kinds of collapses among these companies aren't likely to happen. While one might argue that certain types of companies are likely to trade closer to book value, even those that some suggest should trade at book value often don't. For example, NLE Capital, ticker symbol NLY, is a mortgage REIT that invests primarily in agency-backed mortgage-backed securities. Agency MBSs is a very liquid asset that you can buy directly through your brokerage account. As a result, many suggest that book value should be the prime measure of valuation. Historically, NLY has traded from 80% to 160% of book value. And you can see on the chart here, it's traded around that range since around the year 2000. Since stock prices aren't directly tied to book value, a $1 per share paid in dividends could be worth more or less than $1 in share price movement. Share prices move every day. The value of a dividend in your pocket doesn't. This isn't always a meaningful distinction. If you're in a bullish stock market and prices are always going up, then selling shares can result in very similar cash flows as a stock with identical returns that pays a dividend. If shares are trading at a large premium, then $1 per share on the balance sheet might generate far more than $1 per share in share price. However, when a bear market happens and everything in the market is trading at a significant discount, receiving a dividend or selling shares can be the difference between you destroying your portfolio and coasting through the bear market. This is due to sequence of returns risks. Now, this is really, really important, guys. If you're new to this, sequence of returns risks is the biggest drawback of the 4% rule. It's what keeps everyone up at night. If something's going to keep you up at night and you're retiring off of your portfolio and you plan on selling your shares, this is the boogeyman. The sequence of returns risks is the boogeyman. Now, with dividend investing, you don't have sequence of returns risk. You just don't have it because you're not selling your shares. You have other risks, for example, a company cutting or suspending their dividend, but you don't have sequence of return risk because your share count is not changing. Okay, so that's really, really important that you understand the distinction between the two there, between the 4% rule and dividend investing for retirement. So moving on here, the magic of sequence of returns. I'm going to show you a magic trick. Here's a chart of NLE Capital, ticker NLY, compared to Invesco, QQQ, and the S&P 500 from April 1999 through June 26, 2024. Now, this is what I was referring to earlier with the criticism. This is a little bit, it's not only a little bit, this is like very, very cherry picked. So take this with a grain of salt. He could change the dates here and make an entirely different point. But what he's saying here, I don't want to discount what he's saying because this could be a reality if you were living in 1999, and you had the bad luck that you were, in this scenario. But just take this with a grain of salt and just understand that you just never know when you're going to have good or bad timing. Okay. So what he's showing here, you can see on the graph, the performance since 1999 in NLY and QQQ. On a $1 million original investment, QQQ more than doubled in the following year before the dot-com bubble burst, causing it to underperform from 2002 through 2024. QQQ caught up and outperformed NLY. So the timing here, if you were one of the unlucky ones who was fully invested in 99, you were unlucky. And that's really the point of sequence of returns risks, is you can get unlucky. And you just don't know what Mr. Market is going to end up doing. So if you could go back in a time machine and had to choose one of these holdings to buy and hold no matter what, QQQ would be your choice, right? After all, it ends up with an extra 1.3 million in value. Who doesn't want an extra 1.3 million? Now for the magic trick. The same time period, the same tickers with one small change. You see, the investor with $1 million in 1999 likely felt very good about retiring. $1 million is still a good bit of money today, but in 1999, if you were a millionaire, people thought you were set for life. I still remember that, everybody. Everyone who's a millennial or older, you know, back in 2000, if you had $1 million, you thought you could live for, on that forever. So it's a whole different world that we live in today. So if that investor retired and started withdrawing $40,000 a year indexed to inflation, so about the 4% rule. So what this means here is you're going to increase it based off of inflation. So that 40,000 is going to go up each year, pegged to the historical inflation rate. So that's kind of how the model works with the 4% rule. NLY goes from slightly underperforming to dramatically outperforming. The investor in QQQ using the 4% withdrawal rule has to be extremely concerned. They have 129,000 left from the original 1 million, and the 4% rule prescribes withdrawing over 75,000 in 2024, something that clearly could not be done safely. Meanwhile, the NLY investor has 6.5 million in share value, income of over 765,000 in 2023, and is withdrawing less than 10% of the income to meet the target withdrawal. So this is the key thing here. In sequence of returns risk, if you get unlucky with the timing, you can really shoot yourself in the foot. That's what it comes down to. And so if you're planning on living off of your portfolio, you can get unlucky. And nobody plans on getting unlucky. Who wants to be unlucky, right? Nobody plans on it, but that's just the reality, is you just never know. And so he lists here, the annual returns of this scenario here on the chart. So if you want to pause the video, you can do that and take a look at those. How can such a relatively small withdrawal cause such an enormous difference? Let's go back to where the wheels came off and look at the annual returns in the early years. Pay attention to the value of QQQ in 2000 through 2001 without withdrawals. So without withdrawals in 2001, QQQ was just over 740,000. Massive drop because that was the dot-com bust. And in 2002, the portfolio dropped to $464,000. Now compare the same numbers with cash being withdrawn. So if you're living off of QQQ during the dot-com bust, your portfolio goes down in 2002 to $365,000, essentially making it near impossible to recover because you're also withdrawing in a bear market. The withdrawals caused the QQQ position to be worth 21.5% less by 2002 than it would have been if the funds stayed invested. In essence, the investor was forced to sell shares at poor prices. So by 2007, without withdrawals, QQQ was able to fully recover and survive the great financial crisis. With withdrawals, it was only able to recover $489K, and in 2008, it was at $234,000, while withdrawals were approaching $51,000 a year, forcing the selling of even more shares at low prices. Tell me again how selling shares is no different than dividends. Now that is shots fired at all of the dividend haters. Tell me again how selling shares is no different than dividends. And then you got all those people saying, well, the share price drops exactly by the amount of the dividend. Yeah. But you're not selling your shares at a depressed price. So once again, I'm going to read it for the third time. Tell me again how selling shares is no different than dividends. Okay, so this is a huge flex as a dividend investor, even though I will say, I want to be fair. The cherry-picked example with NLY is very much a cherry-picked example. I wish that he would have used like an index, a dividend index, and not a single company. It's like apples and oranges. Whenever I do comparisons, I try to keep them, comparable and not make, apples to oranges examples. So moving on here, selling low destroys capital. It's math. If you're selling shares at low prices, then when the price recovers, you will hold fewer shares, and therefore it will take more upside to get back to even. With an income approach where the amount of dividends you receive is greater than your withdrawals, you are buying more shares when prices are low. The fastest way to devastate your retirement portfolio is to be forced to sell shares when the prices are low. The income method is a strategy designed to avoid ever being forced to sell shares to withdraw income. This way, you can decide to sell you on your own time at good prices. Note that dividend investments are not magic. They do not guarantee that you will get a particular dividend indefinitely. They can perform exceptionally well or poorly. Dividends can be cut, raised, or even suspended. Also, if you withdraw more cash than is produced by your dividends, you may be forced to sell shares at poor prices, creating the same problem QQQ had above. Now, everybody that invested into Intel understands how dividends can be cut and suspended. So dividends are absolutely never guaranteed. A well-constructed income investment strategy incorporates these risks. This is why we recommend having a diversified portfolio of at least 42 income-producing investments rather than all of your investments in a single ticker. Then why did you give the example with a single ticker? But I understand, I get so critical. It's one of my pet peeves. I hate it when articles or videos make definitive examples with one single stock. I think it's stupid. But moving on, we recommend an allocation to fixed income, which tends to be more stable. Finally, we suggest planning on reinvesting at least 25% of your dividend income, both to provide a source of income growth and also to provide a buffer in the event that we see a period of higher than average dividend cuts. Now, I like this. This is a different approach. So I love seeing other opinions and approaches of how to retire off of dividend investing. Now, I will be very candid. I do not do this, and I've never considered this. I think, if you are capable of generating, say, for example, you need $100,000 in, dividend income. And what they're suggesting here is that you get, $125,000 and then you reinvest the $25,000 that you don't need. So that it ensures that your portfolio is growing, et cetera. I think if you're in the position to be able to do that, kudos to you. Now, a lot of these, the people like Beyond Savings and Rita, they're invested into high dividend stocks and ETFs that are a little bit more, speculative. And so they kind of are required to do that because they're taking on more risk with higher yielding investments. And so it can probably work for them. But if you're investing in, ETFs like SHD and DGRO, I don't think you really need that buffer of 25%. I think this is more for those, if you're investing a large percentage into Annaly Capital, a mortgage REIT, well then, yeah, you definitely want a buffer. But if you're investing into high quality companies, high quality dividend growth ETFs, I don't think this 25% is necessary, but to each their own. And it really just comes down to your particular situation, risk tolerance, etc. Moving on, what dividends are not? Dividends are not magic money conjured out of thin air. They are payments paid by a company or fund to shareholders. These payments come from cash that the company or fund acquires. Where does the company or fund get that cash? It can vary. It can vary for the same company across different payments. So now he's listing how do companies pay a dividend. They're not free money. They're not magic. So the first way is the cash on hand. So the money that the company has is through cash on hand. The second way is through operating cash flow. So a company is their regular operations. They're generating cash flow, whether it's a REIT or an individual, a regular company like a McDonald's or a PepsiCo. They're generating cash flow, and that free cash flow is what funds the dividend. The third way is investment income. If they're investing, they're going to generate income through an investment that they can then use to pay out their dividend. The fourth way is capital gains. If they make a sell or if they sell an asset, then they're going to use that as a way to pay the dividend. The fifth way is through borrowing. Now, this is scary, guys. When you see a company just burdened by debt, that's an issue. Okay, if you see a company like T-Mobile, I'm going to cherry pick an example, T-Mobile, and a lot of telecom companies who have massive amounts of debt, they're paying their dividend a lot of times through debt, through borrowing, and that's not a good sign, and that it's a huge red flag. And so if you can screen your dividend portfolio by the amount of debt that they have relative to how much they're paying out in dividends, it can be a good indicator for or against investing into that stock. And then the sixth way is through raising capital. They can raise capital through issuing common or preferred equity. And the last two, you ideally you want them to be generating in a Goldilocks scenario. You want the company to have enough free cash flow that their business, their operations are funding the dividend. You don't want them paying the dividend from cash on hand or borrowed money. You want their operations to pay for the dividend. Moving on, when evaluating a dividend paying investment, it is critical that we take the time to understand the business model of the company and where its dividends are going to be paid from. Obviously, we want to avoid companies that are funding their dividends primarily through temporary or unsustainable sources like borrowing, unless we have a very clear picture for how they will achieve coverage in the future. There is no shortcut. Using a metric to screen investments to narrow down the number of options you want to do a deep dive can be helpful. However, you cannot rely on headline metrics to tell you how the dividend is being paid and whether or not it is safe. There are always numerous things going on within a company. They might be increasing their overall debt level to expand, but the dividend is comfortably covered by existing operations, or a company might have significant capital gains that won't be reoccurring, making the dividend appear covered when it won't be in the long run. So really looking under the hood, so important. So in conclusion, dividends aren't magic, but they are capable of performing a very incredible magic trick. They can prevent you from being forced to sell shares during a market downturn. Share prices are volatile, and they can often have very little to do with the underlying business. For those of us who are not forced to sell shares, the volatility of share prices is an advantage. We get to choose on any particular day whether we want to be a buyer or a seller. That is so profound. You get to choose when you sell versus being forced to sell in a down market. So important. For those who are forced to sell shares, the volatility of market prices is a great risk. Selling shares at poor prices is the greatest threat to a retirement portfolio. Unfortunately, it is something that many find themselves doing out of fear or necessity. An income-based strategy can help deal with some of the complications created by volatile prices. We have a tangible measure of what we are getting paid. Just like with your job, you know exactly how much you get paid. Live on less. I'm not going to tell you I have a secret code to avoid losses. Life isn't a video game. There's no cheat code. Anyone who tells you they have a way to guarantee you to make X amount of money without a risk of loss, buyer beware. What I will tell you is that if you take time to approach the market in a reasoned and logical manner, it can be a great generator of wealth for you. You will need to keep a level head, avoid panicking, and work to identify the best investment options for your goals. Focus on what the companies do and how they generate cash to pay the dividend. Make your best estimate as to whether or not they will be able to continue to do that. Sometimes you might be wrong, and that's okay. Focus on building your income and make sure you are withdrawing less. Maintain a cushion of excess dividends, and if that cushion shrinks, that it is a warning sign for you to change things in your portfolio. The greatest benefit of an income strategy is that you are not faced with a decision that so many had to make in 2001 and 2002 on whether or not it was safe to withdraw funds. Since you aren't spending money until it is paid to you, you know the budget you have to work with, and you know if you need to do something to either increase your income or reduce your spending before it's too late. More often than not, investors who take an income approach to the market will be surprised at just how much income their portfolio is capable of producing. They often get to enjoy the magical feeling that comes with having a lot of cash flow. So that's the article. Let's take a look at some comments and then we'll wrap it up here. Good article, and the reason more people don't employ dividend investing is because it's get rich slow and everyone wants to get rich quick. And yes, good luck and God bless those smart enough to time the market and sell shares to fund retirement. It's so true. A lot of people, they just want to see their portfolio 10x in a year. They might get lucky once, but to do that year over year, it's easier said than done. And especially in retirement, do you want to see that volatility in retirement? Oh man. Another comment here, we were put in the position where we had to sell some of our assets because we had to retire early. I've experienced the pain of having to sell when prices were lower and saw just how fast an SA can drop. But once we went with the income method, it turned around pretty quickly. We had enough cash to pay bills and reinvest to keep our income growing each and every month. Counting on what the herd mentality of the stock market will pay for my investments when I need to pay bills is not how I want to retire. I can absolutely relate with that. And when he mentions here the income method, I think this is, a lot of what Rita and what Beyond Savings, they talk a lot about on their investing group here on Seeking Alpha. Another one here. So what happens if the company, were to cut the dividend after a share price drops? And I like what Beyond Savings says here. What happens when you buy a stock for growth and it flops? You realize your loss and you move on. Investing comes with risk, and if you invest long enough, you're going to have some investments that are just ugly. There's nothing inherent about companies that pay a dividend that prevents them from being either good or bad investments. This is why we promote diversifying and planning on reinvesting at least 25% of your dividends. This helps offset those investments that go sour so that you don't have to be perfect or lucky. I really, really like this comment. It's a very grounded way of looking at this. You're not going to have all the answers. You don't know what the market's going to do. So prepare for it, plan for it. And the way that Beyond Savings plans for it is by investing, having 25% of your excess income reinvested into your portfolio. Like I mentioned earlier, I think it really depends on the investor, and it depends on the investments that you're investing in and the amount that you have invested. So I really like, all in all, I think having those guardrails in place can be so important. So all in all, I give the article a B. The reason why it gets a B instead of an A is the criticism that I had with the cherry-picked example of the single stock versus an index, I think he could have easily just used a dividend index to make it apples to apples. So I don't like the cherry-picked example. That's why the article gets a B. I want to be fair. And another thing, articles like this, they kind of tend to, because it's just a simple article, right? It's not going to account for every variable, but what you'll often notice is that they generally will use like the doomsday example, the dot-com bust, financial crisis. They'll not have any, scenarios where they assume that the person had an emergency fund or used maybe a 3-bucket strategy where they had cash on hand so they didn't have to pull directly from their portfolio. It highlights the worst case scenario. And if you're a new dividend investor and you're thinking about, okay, do I invest in the market, whether it be QQQ or the total US stock market or the S&P 500 versus investing in a dividend portfolio, there are pros and cons to both, right? There's no one size fits all. There's no guaranteed approach. And that's why I'm trying, when I review these articles, I want to have a level-headed approach, and I don't want to just praise one approach or the other. That's why I love the title of the article, Dividends Are Not Magic. They're not magic, but they can be in certain situations, and they can be very beneficial. And it's really, really important that you, the investor, understand why you're investing and what's important to you, and to educate yourself on both sides, the pros and cons of investing in the 4% rule versus investing in a dividend approach to live off of your portfolio. And you'll notice here, Beyond Savings referenced having a dividend portfolio of 42 individual stocks. He didn't talk about anything like ETFs, so he does something entirely different than what I recommend on my channel. And if you follow the channel, you know that I talk about the simple path to wealth with dividend investing, which was inspired by J.L. Collins, keeping it simple, where I focus on investing in my core portfolio of SEHD and DJRO, following the core and satellite. So SEHD and DJRO is your core, and then you build upon your core based off of your time horizon. If you need more growth, your satellite positions, which are smaller positions, are tailored towards that purpose. If you're an income investor because you're retiring tomorrow, well, you skew it, you focus it more on income. And that's why I love the core and satellite approach to investing, because it really, you can tailor it to your specific needs and goals. So everybody, that's the article. As always, everybody, I'll be back next Thursday with a new article. But yeah, thanks for watching, and I'll see everybody in next week's video.